Okay, it sounds like that worked. Okay. Good afternoon, everybody. Ben Mendenhall, the administrator for the Centennial State Liquid Investment Pool here, our newest local government investment pool option in the state of Colorado. And this is an ongoing commitment to keep our participants and the local governments of Colorado educated and informed on what's happening not only in the national landscape, but also here in the state of Colorado. And our Board of Trustees is very adamant about providing education, communication, and service to all local governments here in Colorado. So we're absolutely honored that you are able to join us today. And it's a gigantic honor to introduce, in my opinion, the godfather of public funds investing here in the United States, Mr. Marty Margolis. And Marty is the driving force behind the Public Funds Investment Institute and founded the company that grew into PFM Asset Management. Many of you have probably heard of them, the nation's premier public sector investment manager. And he led the company for 40 years until it was acquired by a regional bank in 2021. He also pioneered in creating the first grassroots local government investment pool, much like CSLIP, in the nation in Pennsylvania. Also, the first state-sponsored non-arbitrage pool in Virginia, and the creation of a multi-asset class outsourced chief investment product while at PFM, and the development of a robust national separate account business. When he left PFM Asset Management in 2021, it had over 150 billion in assets under management. So going from 150 or 0 to 150 billion in 40 years is very impressive. And I had the privilege of working for Mr. Marty Margolis when I was at PFM a long time ago, but was there for 2 years, and it was an absolute honor to learn from him and to work for him. And we were very privileged to have him as our speaker today on our webinar. And we're going to cover a lot of various topics, all based around local government investment pools, and provide some value for our local governments. And if you do have questions, please be sure to put them in the chat, and we will do our best to address them as they come in. Or if we have a flood of questions, we are dedicating some time at the end of the webinar to address those questions. And our main goal here today is to have you leave this information session with one or two or more pieces of information that you didn't know before. So with that, we are going to go ahead and get started here. And we do have the screen up. And Marty, you ready to go?
Sure enough.
Okay, excellent, excellent. Well, the first question I have for you is you created the Public Funds Investment Institute. What's it about, and what inspired you to start it? And give us an overview.
Well, I've been interested in this business as long as I've been in it, and maybe that sounds like an odd thing to say, but sometimes people get into a business and then they lose interest in it, but they need a job, so they work at it. I've been interested in it for the entire time that I was in the business. When I left the business in 2021, I was really interested in seeing if we could build an organization that would support the public funds investment community. I think the community lodges, a lot of other organizations, whether it's GFOA or the government investment uh, um, organization, or various county and state organizations, but they often don't have the prominence and focus that I think public funds investing should have. So we created this nonprofit, got some funding for a couple of years, are off working on it, trying to prove the concept or not. That a support organization that could support the activities of public funds investors within the confines of other existing organizations would have a life. And that's what I'm working on. I have some help. And as I say, I have funding for about 3 years, hope in the longer run to prove the concept and find a home for it in a think tank or academic setting. And it's as simple as that.
Excellent. Well, I've got to say that I was following your website, pubfunds.org, very closely, especially over the last 18 months, and it's been a fantastic resource, not only for us in the creation of the Centennial State Liquid Investment Pool, or CSLIP, but also for local governments nationwide. And it's a fantastic resource for local governments. So it's, again, an honor to have you. And we're going to break the presentation into a couple of different segments here. And the first is a history of local government investment pools. So Marty, maybe you can tell us about how and why you paved the way for the first local government investment pool in history.
Well, the way was actually the way was actually paved by somebody who was the executive director in Pennsylvania of an organization for small municipalities called boroughs, and he was interested. He was interested in developing an investment alternative to banks and money market funds, and he stumbled on my company. We were a startup, just two of us initially, and asked us if we would help him set up something under the Intergovernmental Cooperation Act. If you go back a long period of time, there was no such thing as a local government investment pool, but there was a statute in Pennsylvania that encouraged intergovernmental cooperation. We got working on it, and as we were working on it, Vanguard, you've heard of Vanguard, of course,
Yes.
at that time was a small startup as well. And we through some serendipity, we teamed up with Vanguard. Vanguard gave us the responsibility of managing the money, and they did the initial marketing and the initial administration. After a couple of years, the company I helped start took on the marketing. We didn't take on the administration until the mid 90s, and we were off and running. And it was the first grassroots LGIP in the country, not the first LGIP, but the first one that started solely through the efforts of local governments. Started with two local governments. Today it has, I think, about 3,000 participants. So it's grown a good bit, and it's been a great model. And as it's propagated to other states, the LGIPs have taken on some different characteristics and flavors, depending on the nature of the state and the nature of the statutes in the state. But the common threads are a board of trustees or directors at the local level, an investment advisor, and some firm that does distribution and administration. It may be the same firm as the investment advisor, or it may, as you have been created, separate firms that do those activities. States also operate LGIPs. You don't have a state-operated LGIP in Colorado, but states operate LGIPs as a maybe a core activity, maybe an offshoot activity of state treasury activities. And there's about $1 trillion around the country in LGIPs. 32 states have state-sponsored programs. There are close to 100 local-sponsored programs. State-sponsored programs have both state treasury seed money, if you will, and local government money. And then locally operated programs like your program have just local money. We do an annual survey to keep tabs on this, and we'll be coming out with the results of the new survey in July. I kind of know the results. The $1 trillion comes from those results. The $1 trillion is split up kind of like what you see on this pie chart. There's about $600 billion of local money, and there's about $330 or $40 billion of state assets that reside in LGIPs.
Wow. Wow. That's those numbers are just completely staggering. And it's amazing to see the growth, over the last 40 years in the industry as a whole, and I think they really provide a unique investment vehicle that can be locally managed, in their best interest. So that's great. Now, what challenges did you face in creating the LGIP in Pennsylvania? I know we had ours here, but what did you experience back then?
Well, in the initial days, the big challenges were that the banks really felt that they were attacked by this organization, and they fought against they fought against its establishment. The kind of really interesting thing is that two of the initial trustees were closely affiliated with financial organizations. And I was always very proud of the fact that, notwithstanding their close affiliations, they kind of put their public service hats on. And I think they kind of bucked their industry in a way and supported and encouraged the development of the Pennsylvania Fund. And it really helped get us off the ground. And that's something that really was interesting and is still interesting. One of those trustees is still around. He's not a trustee, but he's still working. And he's going to be 104 years old next month.
Wow.
So, great inspiration for me.
The greatest generation, they're
Yeah.
still ticking. That's
Yeah.
amazing.
Yeah.
Well, a follow-up question to that, why are local government investment pools so unique, and how do they compare to money market funds?
Well, that's a good question. Another good question goes back to Pennsylvania. When Pliggett started, Federated, which is housed in Pennsylvania, had some money market funds, and the Federated suggested to the Boroughs Association that they support and sponsor one of the federated funds rather than creating their own. But the association wanted to have something that was under the control of local governments, and they went on their own and created the first program in Pennsylvania. That's been a hallmark of these programs around the country, has been kind of local control, shaping the fund for the needs of the locality. In the last 20 or 25 years, the money market industry has grown phenomenally. It's got about $7 trillion of assets in it now, but
Wow.
it has also been required to follow a series of federal regulations promulgated by the Securities and Exchange Commission that have, in some manner, limited the abilities of money market funds in ways that are not limited for LGIPs. LGIPs are exempt from that registration. So these days, just looking at things from 30,000 feet, Ben, you have government-oriented money market funds, and you have government-oriented LGIPs. The fundamental difference is that there are mandatory minimum liquidity requirements for money market funds that don't apply to LGIPs. And a result of that is that LGIPs generally will out yield their analogous money market funds by a couple of basis points, 2 or 3 basis points. The LGIPs have had no experience, adverse experience with what you call hot money. Money funds have had that kind of problem, and that's why they have these strict liquidity requirements. In the prime space, CSLIP, I think, is a what we called a prime LGIP because it invests in some credit instruments. You have a similar differentiation, and you prime money market funds cannot offer a stable net asset value, whereas funds like CSLIP do offer a stable net asset value. Prime money market funds also are required to impose redemption fees from time to time. CSLIP has no. I'm not advertising CSLIP. I'm just using it as an example. CSLIP has no requirement like that. LGIPs have no requirements like that. So again, you have a little bit more flexibility. You have a history of stability. There's of course some view that without the SEC looking closely over your shoulder, you might get into trouble. But the LGIP industry has been very good at avoiding problems. the LJP industry has had a history of avoiding the hot money problem.
Yeah.
And the prime LJPs also offer yields as a general matter that maybe are 3 to 5 basis points higher than the yields of prime funds. And again, the big differentiator is the stable net asset value as compared with one that's not.
Yeah.
So that's how things line up these days.
No, that's greatly appreciated. And we're going to move on to the next segment of our webinar podcast here, which is current trends of local government investment pools. So let me make sure I'm on is this the right slide here
Yeah,
to
yeah,
start on? Okay, well,
yeah. That's a good place to start.
yeah, and the first question I have for you with local government investment pool trends is what trends have you observed in the LGIP space over the last decade?
Strong growth in assets. You see that from the chart that's here. The overall trend for public funds assets has been solid growth here, going back 5 or 6 years. The economy's expanded. There's been a lot of federal aid that's gone to state and local governments. It's found its way into rainy day funds at the state level and surplus funds at the local government level. Maybe that will change here going forward. But the result has been that investment accounts have grown significantly since 2019, up nearly 40%. And LJPs have grown more rapidly than that. So we don't have a good measure of the overall size of the LJP market, but we have a measure from Standard and Poor's about the growth of the rated LGIPs, and that's that lighter color line on the right-hand side. They've grown much more strongly even than the growth of overall public sector investment assets. So strong growth in assets has been one. A second thing has been a continued entry into the LGIP business of new funds. So you're experiencing that in Colorado. Yes. But it is interesting, I think, if you step back, that notwithstanding that states like Texas or Florida or Colorado might be viewed from one perspective as being, quote, mature markets for LGIPs, those three states have had significant new entries into the LGIP business in the last 2 to 3 years. And I'm somebody who believes that competition is good. I'm somebody who believes that having a number of choices is good for local governments. And I'm encouraged by the result of new entrants and competitors in markets that would appear otherwise to be kind of mature markets.
Yeah.
So we've seen it happen.
No, that's great. That's great. And maybe you can touch on why local government investment pools are such an important tool for public entities.
Well, I think public entities, all entities are challenged to invest money these days, but public entities are I think, particularly challenged because they have, as a general matter, a narrow scope of permitted investments. They have a high degree of uncertainty with regard to cash flows and balances over time, and they have a high level of scrutiny because they're in the public sector. So they all public sector officials live. I always say they live in a fishbowl, yeah. and the provider industry has changed a lot in the last 2 decades. The broker dealer community and banking community is very different today than it was, and unless you're a really large public agency with a deep pocket to be able to afford to build and staff up an investment function, it's really, I think, challenging to get your money invested, keep your money invested, and importantly, stay out of trouble. And LGIPs provide not the only tool, but a really good tool for local governments to be able to do that. there was a time, Ben, when people characterized the money in LGIPs and money funds as lazy cash. They would kind of say, "Oh well, if you did your job better than you do it now, you wouldn't have balances in these short-term accounts." Or in the money fund industry, you hear the brokers say, when are people going to move that $7 trillion into the stock market? Well, I think we all learned or had reinforced a lesson that it's not lazy cash. It really should be thought about as an asset class. So the money that's in an LGIP, what are its asset class characteristics? Low risk, high liquidity, and a yield that tracks very closely the yields on other short-term investments. It's not maybe someplace it's lazy. Maybe some treasurer is lazy and leaves money in the LGIPs, but a good argument can be made that it is a really appropriate place to have cash, um, to have money invested in cash equivalent accounts as part of an investment program.
Yeah, and I think that's well said, and I think where it really hits home here in Colorado is, you have your urban communities, here in the Denver Front Range area, the Denver Metro, we call it the Front Range here in Colorado. But then when you get out into, some of the communities, out like the town of Meeker, for example, or Uray, where they don't have an army of, people that can do credit research and evaluate, security selection and manage a full-blown investment portfolio on behalf of their taxpayers. It really provides a diversified, professionally managed approach to capturing yield without sacrificing safety and liquidity. So, that's well said, and I think it really, hits home when the further into the middle of the country you get. You tend to see less and less resources as you get away from the coast. So that's really well said. And I guess a really interesting question that I have for you that's become very timely recently is, what are your thoughts on large financial institutions showing interest in creating or acquiring local government investment pools?
Well, a couple of thoughts. I, you know, the stability offered by a large financial institution is perhaps a positive for local government investment pools. The resources offered by the investment function at a large financial institution is a positive. On the other hand, large financial institutions are in lots of businesses, and they may not have the interest in doing innovative things. They may not have the interest in doing more than maintaining a fund. And if the financial institution is a bank, they may, and I'm making this as a general comment, they may view the LGIP as a way to raise deposits in the long run, a door opener to raise deposits in the long run. Those are all good business objectives. They aren't objectives that I necessarily share, and so I think you get some positives, deep pocket stability, some things for a board to be thoughtful or cautious about if you're involved with a large financial institution.
Yeah, no, that's really well said. Well, moving on to our next segment, based around liquidity rates. That's probably the big question that most of the participants on the webinar here have is, where what's going on out there. It's been a really interesting market, and going back to when I first started 20 years ago, going through a financial crisis, going through a banking crisis, going through a pandemic, going through trade wars, going through historic inflation increases. I mean, it's been a wild ride for the last 20 years, and that's not even including the extra 20 years that you had, navigating all these markets. So, can you provide us with an overview of how liquidity rates have changed since August of 2023?
Well, I have. I mean, first of all, if you go back further than that, you don't have to go that far to recall when LGIP rates and all other short term rates were in the 20 basis point or less range, right?
Yeah.
That's not that far in the past. Um, we saw this very large, very rapid, and somewhat unforeseen rise in short-term rates beginning in the middle of 2022, and then we've seen a plateau and we've seen rates come off a little bit. I think the chart that you put up here might be interesting to people because it goes back to the matter of just the prior table, Ben, goes back to the matter of how competitive LGIPs have been over the past couple of years. This is a period when short-term rates had already peaked, and so we're not looking at the period when rates rose rapidly, and of course LGIPs did better than longer maturity investments. We're looking kind of at a period of relative rate stability, where LGIP yields have been right on track with the yields for longer maturity investments. And you run this analysis back 10, 20, 30 years, and you see a similar pattern. They're not necessarily the best rate over a period of time, but they're always right up there. What we know, if you go on to the next slide, just it illustrates this. What we know is that LGIP yields lag the cash market, right?
Yes.
So in the period from this period of rate rises, you can see on the chart on the left-hand side how Fed funds, which represent cash rates, rose in steps, and LGIP yields kind of kept abreast of that with a bit of a lag. Over the entire period, cash rates were a little bit higher on average, but only a little bit, than LGIP rates because of that lag. They lag on the way up, they lag on the way down. So the chart on the right-hand side shows that on the way down, they lag as well. The Fed cuts rates, and that reflects itself in the cash rate tomorrow. The LGIP rate moves over the weighted average maturity of the LGIP, whatever that is, 30 days, 40 days, 50 days, something in that range. So for a while, the LGIP will offer a small rate advantage over the rate in the cash market. And in the case of this cycle, it's also measured in single digits. That lag can provide opportunities if you're a large, significant investor in the public funds market. You can imagine what those opportunities might be to earn small arbitrages by moving money between an LGIP or a money fund and the cash market. But they were small opportunities and they're brief opportunities, and they'll continue to be.
Interesting.
So one of the things that I think public funds investors often struggle with is when to move money out of an LGIP into the cash market. And you hear this all the time. I'm gonna keep my money in the LGIP until rates drop. And when rates drop, I'm going to go out and I'm going to grab a 6-month or 1-year investment. I think folks like us kind of hold our heads and say, it's not quite that simple. And public funds investors may hold their heads and say, oh, you guys are just trying to market to us. You're just trying to convince us to keep money in LGIPs. Well, here's a chart on this page that is put there to try to demonstrate how really hard it is to time the market. We went back and looked at the level of fixed-term rates and LGIP yields over the last 6 or 8 months. And if you're an investor in the public fund space, try to transport yourself back to last summer when LGIP rates were flirting with 5.5, and 1-year rates were flirting with 5 or 5.25. And think honestly about whether you would have moved money from your LJP account to, let's say, a 1-year investment um, because of market timing. And somebody would say, "Well, of course I would have done that," but predominantly people are waiting for the crossover to do that. But the reality is that the 1-year market, the 6-month market, anticipates moves by 60 to 90 days. So you've got to have a really good crystal ball, and you've
Yeah.
got to have a really strong view of the market. If what's going to motivate your investment decisions is to try to arbitrage against an LGIP. And this goes back to the fundamental question and matter of what should drive your investment strategy in the public sector. And it's I would hope it's not an attempt to beat the market.
Yeah, no, well said. Well, here's speaking of crystal balls. I know mine is pretty cloudy these days, but what do you feel? Where do you feel rates are headed? With the current economic environment over the next 18 months?
Don't know. Don't know. I think you hear it from everybody. The level of uncertainty
Yeah.
around the course of the economy and the course of the markets, uh, I don't think it's ever been higher than it is now. And there are a couple of different paths forward, and they produce arguably monumentally different outcomes with regard to rates. So you hear that if you're on CNBC or Bloomberg TV or Business Fox or whatever, you hear all this discussion about the federal funds futures contract. Oh well, Fed funds futures contract now calls for the Fed to cut in June. Oh well, the Fed funds futures contract all now calls for a rate of 3% by the first quarter of 2026. Um, keep in mind that those are not, see if I can describe this, those are not single paths forward. That 3% rate represents the betting of some people who think rates are going to be unchanged, and some people who think we're going to have a recession and rates are going to be 1%, and some people who think somewhere in between. And if you take those multiple paths and you apply a probability to them, you end up with, quote, a central tendency or average for the Fed funds rate to be, let's say, at 3% in 9 months. But in reality, in my view, it it could be 4%. It could be 1%. Those all can work out to a central tendency Fed funds outlook of 3%, but they result in radically different paths for short-term rates. And when you're doing your investment planning, when you're coming up with your investment strategy, this goes back to my fundamental point of not trying to time the market, and my fundamental view that when you come up with an investment strategy for a city or a county or a school or a special authority, the market is not what should dictate that strategy. The budgeting and financial management and cash requirements of your organization should be what dictated. Do you want to have a return that has a certain amount of stability over time, maybe lags the cash market from time to time, or do you want to have a return that keeps up with the cash market? You can model both of those. You don't have to be a rocket scientist to do a little back of the envelope Excel modeling of both of those. and you can reflect on those with your budget and financial management folks and think about which of those produces the desired result from a budget and financial management perspective, and then go forward with that. So when I say I don't know where the economy is going to be, I don't know where rates are going to be, it's for that reason. Because to some extent, to a big extent, when I think about investment strategy, I don't want to think about the economy and rates first. I want to think about the other drivers first.
That's really well said. And we actually had a timely question for this topic come in from a student of the markets, and he actually is at Larimer County in the treasurer's office, and this young man is really, I admire how he's wanting to learn, and that's Caden Colburn. And his question to you, Marty, is what's the length for a majority of short-term maturities? What are the types of investments, and if bonds callable or bullets preferred? I know that's a three-part question, but I thought that was very timely for what you just mentioned.
Well, what you see uh, uh, around the country is where you have larger investment portfolios that are managed by public agency investment portfolio managers. These days, they tend to have average maturities, I would say, in the 600 to 800 day range, right? So,
Mm-hmm.
so maybe a little under 2 years to 2.5 years. And I say that from knowledge that I have about large investment portfolios managed by public sector investment folks in Texas and Florida, in California, which are very large, obviously very wealthy states. At the other end, where you have small and mid-sized portfolios, you tend to have investment portfolios that look like they first of all match the cash flow requirements out for the balance of a year. So you may have maturities staggered out for dates that are known for significant cash outflows. Maybe it's a debt service payment, maybe it's payroll payments, so forth and so on. And they tend to be in a budget cycle. And then you have the balance of the money in either of those large portfolio strategies, or what I call the small mid-sized portfolio strategies. You tend to have the balance of the money in a deposit account, an LJP, or a money market fund. Maybe by order of magnitude nationally, LJP balances are larger. Bank deposit investment balances are smaller, and money fund balances are maybe the least sizable. So that's what they tend to look like. If that's getting at the question.
Yeah, and I think that's helpful. And Caden, if you have a follow-up question, go ahead and feel free to put it in the chat. And we are running short on time here, so I do have a couple of more questions for you, Marty, before we open it up to the audience, and maybe we just go with one of them. But what is, in your opinion, really being a pioneer of these local government investment pools, what is the best practice model, for a local government investment pool from your perspective?
Well, um, uh, you maybe odd for me to say this, because I made a good living for 40 some years as an investment advisor, and we thought that we were pretty good at all of this, and thought we should be given responsibilities. But the thing that I think is the most important for an LJP is to have a board of trustees that is active in a fiduciary capacity, and is not simply saying yes to everything that the advisor may come up with, but is providing thoughtful guidance to the contractors to the fund, and really thinks about the fund as the board's fund and not PFM's fund, or not Ben's fund, to not to be offensive, Ben.
All good.
I think that's really important in terms of the long-term success and viability in this business. The second thing I think that's important um, for the business is to have for local governments to support multiple investment providers. So way back when we were getting started with Pliget, I had a good friend who had worked with me at the state, who worked for the Pennsylvania Association of School Administrators, and I was trying to convince him that they should endorse Pliget and quote walk away from, I didn't use those terms, a competing fund. And this guy was a really good friend of mine, and we worked together closely. And at some point, he said to me, "You know, we're never going to do that because you run a great organization, you have a great organization, but we don't want to have all our eggs in one basket." And I respect that view today. So the strength of LGIPs in Colorado, for example, in my view, is around the fact that you have multiple LGIPs, and local government should have that in mind for security purposes, for safety purposes, for other purposes. They should, make sure that they have some environment of strongly competing forces.
Well said. Well said. I couldn't agree with you more. And, speaking of, having great board leadership and really, looking out for the fund as a fiduciary, we have one of our board members, Doug Farman, the controller for the city of Thornton. And I know that Mr. Farman is probably full of questions, but wanted to open it up to Mr. Farman to see what questions he has percolating.
Well, thanks for being here, Marty. You did mention a 600 to 800 day average maturity, and I thought that was timely right now with all the uncertainty in the marketplace. Do you think it would be prudent to stay on the shorter end of that range at this point in time and keep more funds in cash or the LGIP?
Yeah, I do, Doug. But my view is not a view about interest rates. It's not a view that I should shorten my portfolio because I think rates are going higher. It's a view that I should shorten my portfolio perhaps because there's so much uncertainty around what the cash flows in revenues are going to be and what the cash requirements, budgeted expenses are going to be over the next several years, right? So it's not a market call. It's sort of a budget and finance view, if you will. That balances could be somewhat stressed. That state and local government expenses are unknown, but they could rise because of changes in federal outlays, particularly. They could rise more if the economy turns down and you have demands on state and local governments and lagging tax revenues. So, what do you do about all of that? I think you want to tend to emphasize building up liquidity at this point, and that would lead to a shorter weighted average maturity.
All right.
Yeah, I think that's a good point. I know our auditor is looking at subsequent events in our footnotes because of the uncertainty around federal grants going forward for entities that really rely on those funds. So thank you.
Yeah, no, that was a great question, Mr. Farman or Trustee Farman.
Could I ask a question?
Yeah, Harsha, go ahead.
Mr. Margolis, thanks for your time. Harsha Sekar, I'm the general counsel to the fund. Where do you see at the state level the regulatory environment moving, if at all? Here in Colorado, it's been pretty stagnant when it comes to LGIPs for a number of years now. Do you see any changes on the horizon that we may need to be be paying attention to, and or do you see a role for kind of federal regulation of LGIPs?
Well, let's start with Washington. The SEC these days is very unlikely to undertake any regulatory activities related to LGIPs. They I'm sure, will continue to enforce the anti-fraud provisions that apply to any activities in the investment space. But it's not likely that they would undertake any regulation like the regulation for money market mutual funds. Now, having said that, the Municipal Securities Rulemaking Board does have a rulemaking activity that relates to municipal fund securities. And it seems to me, from what I've heard, that they are going to continue to pursue some revisions to that rule. It's kind of been a well-known secret that the rule has not been rigorously applied to LGIPs. Whether or not they have the chops to increase requirements that apply that rule to LGIPs is something you should keep an eye on. At the state level, Colorado's got an unusual arrangement among states where the state has some oversight authority over LGIPs. Most states, that's not the case. Some states have a statute that has minimum requirements. Many states have no statute except an intergovernmental cooperation statute. Every year we see some moves at the state level to try to impact LGIP activities. There's some bills in Texas, one of which would put local sponsored LGIPs out of business and require all the money be invested in the state sponsored program. Last year, there was a bill in New Hampshire that was sponsored by the bankers that would have required that the state's LGIP invest its money in New Hampshire banks. That ultimately didn't progress in a manner that adversely affected the LGIP. So stuff like that it will likely be ongoing. Somebody's always going to think about whether they can gain a hand at the state level. But I don't, unless the LGIP industry gets into trouble in a particular state, I don't foresee big moves to change the playing field in any states these days.
Okay, thank you very much. We're very, very insightful. Thank you.
Yeah, no, that was a great question and great insight there, Marty. And I would encourage the audience to, chime in and ask, Marty questions. This is a great opportunity to really leverage a fantastic resource and a wonderful person. So if you have questions, feel free to ask them. This is your time.
Ben, I want to put a small plug in for one thing that we are trying to do
Please.
at the Public Funds Investment Institute, and that is develop some good current investment data to help public agencies kind of know where things are and know what's going on. And I hope folks will take an opportunity to check out what we call the investment dashboard on our website that provides the only real comprehensive indices for yields of LGIPs across the country, and some other kind of hopefully handy rates. And then some recently rolled out, I would think, are a unique effort to track collateralized CD rates around the country. So I don't want to distract everybody, but I hope folks will kind of check that out as they have a chance. And happy to interact with folks away from this call, as you have questions or ideas.
Yeah, and to add to what Marty said, I really encourage the attendees and the future viewers of this webinar, because we will be posting this to our website in the next couple of days, to reach out to Marty, to check out the pubfunds.org website, the Public Funds Investment Institute. I am a daily and weekly reader of the content. I read every article that Marty puts out, and it not only helps us be a best-in-class LGIP here in Colorado, but it helps you, at the individual local government level. And the amount of information that I've absorbed from Marty over the last 18 months and going back to my days of working for him is astonishing. It really is. So you have a fantastic resource here, not only in us, but primarily in Marty. So please, feel free to reach out to him. His contact information is here on the screen. You're welcome to reach out to me. I'm happy to facilitate a connection if needed. But we do this to keep you highly educated on what's happening out there, highly informed on what's happening out there. And without tools like Marty and his website, it makes our job much more difficult, at our level, but also at your level as well. So I really encourage you to absorb as much information as you can from him and subscribe to his newsletters. He doesn't bombard your email with nearly as much as we do probably, but there's a lot of really timely information that comes out, and I would encourage you to research his most recent articles. And we want to thank everybody for taking time away from your busy schedules, your busy jobs, and you really do play an important role for your taxpayers. So we really just want to thank everybody for being here today and hearing what we've had to say, and the future viewers of this webinar. Thank you as well. And Marty, do you want to close us out today?
Well, this is a good opportunity, Ben. I'm encouraged, very encouraged by the fact that you've created another LJP. More is better in this case, and hope that you make continued progress.
Well, thank you for that.
And it's good to see you have supporters, because that's what it takes for an LGIP to be successful.
Indeed. And without the board that we have, and the whole team, for that matter, we wouldn't be here in front of you. And this is a direct thank you, to the state of Colorado local governments. And Marty, thank you for your guidance in helping us. We're a year old now and we're just getting going. So with your guidance and expertise, it'll be interesting to see where we go, in the next 12 months and then the time after that. So thank you greatly for your time today. I hope you're getting some sunshine there on the East Coast. I know that rain can be in the forecast almost every day, but thank you, dearly for your time. And I'll look forward to reading your articles and reaching out to you here in the future. And I encourage the audience, to get engaged with Marty. He's here to help. So thank you everybody for your time today. Feel free to contact me directly, any of our board of trustees. If you have questions, we're here to be a resource for you. So thank everybody and have a wonderful rest of your week and a great Memorial Day weekend.
It's a pleasure, man. Thank you.
Thank you, Marty. Take care.